Today, we will talk about the dividends received deduction, DRD. The dividends received deduction is a federal tax deduction in the United States that is given to certain corporations that get dividends from related entities. The amount of the dividend that a company can deduct from its income tax is tied to how much ownership the company has in the dividend-paying company. However, there are criteria that corporations must meet in order to qualify for the dividends received deduction, DRD. The dividends received deduction allows a company that receives a dividend from another company to deduct that dividend from its income and reduce its income tax accordingly. The amount of DRD that a company may claim depends on its percentage of ownership in the company paying the dividend. The Tax Cuts and Jobs Act made major changes to the taxation of corporations, including reducing the DRD percentages for dividends received from domestic corporations. In tax years beginning after December 31, 2017, the amount of DRD that a company may claim depends on its percentage of ownership in the company paying the dividend. Certain types of dividends are excluded from the DRD and corporations cannot claim a deduction for them. For example, corporations cannot take a deduction for dividends received from a real estate investment trust. If the company distributing the dividend is exempt from taxation under Section 501 or 521 of the Internal Revenue Code for the tax year of the distribution or the preceding year, then the receiving company cannot take a deduction for the dividends received. A corporation cannot take a deduction on capital gain dividends received from a regulated investment company. Dividends from foreign corporations have different deduction rules than those for domestic corporations. Assume that ABC Incorporated owns 60% of its affiliate, DEF Incorporated ABC has a taxable income of $10,000 and a dividend of $9,000 from DEF. Thus, it would be entitled to a DRD of $5,850, or 65% of $9,000. Here are 5 key takeaways. 1. The dividends received deduction, DRD, applies to certain corporations that receive dividends from related entities and alleviates the potential consequences of triple taxation. 2. There are different tiers of possible deductions, ranging from a 50% deduction of the dividend received up to a 100% deduction. 3. There are several rules that corporate shareholders need to follow to be entitled to the DRD. 4. For example, corporations cannot take a deduction for dividends received from a real estate investment trust, REIT, or capital gain dividends received from a regulated investment company. 5. Dividends received from domestic corporations have different deduction rules than those received from foreign corporations. Hope this would help. Thanks for watching.